Good morning, everyone, and welcome to the Opportunities and Risks of Fossil-Free Investing. We're going to give a couple of minutes for everyone to file into the room. Usually takes about 30 seconds or a minute, and then we will get this rolling. Our panelists are all here from across the country at their homes. So we're just holding for just another minute or so. All right, well, let's get going. I'm Andy Behar, the CEO of As You Sow, and again, welcome everyone to Opportunities and Risks of Fossil-Free Investing. And happy Earth Day. It's the 50th anniversary of Earth Day today, and we're going to be talking about a very important subject. So I have with me incredible panelists, Bob Litterman, who he's in California. We're all obviously in our homes. We're all sheltering in place. Mark Campanelli is in London, and Kathy Hipple is in upstate New York, I believe, but she'll tell us that in a minute. So just general information. First off, there's a Q&A window that you have on the right. It says questions. You can be asking questions during the entire webinar, and we will answer them all at the end. We're each going to do a short presentation, and then we will have a big Q&A. Next slide, please. So the panelists, again, Bob Litterman, who's a partner at Kipos Capital, and Bob, wow, that was loud, also spent a great deal of his career doing a lot of risk analysis on Wall Street. Kathy Hipple, who's our financial analysis from the Institute of Energy, Economics, and Financial Analysis, or IEFA. Mark Campanelli, who I've known for quite a while, and is a dear colleague, founder and executive chairman of Carbon Tracker, who authored the very first carbon bubble paper that got us all thinking about stranded assets back in 2012. Next slide, please. So we're going to start off with Bob, who's going to give us a good oversight of fossil-free investing and its impact. So I'm going to hand it off to Bob, and the rest of us are going to mute our videos while Bob speaks, and we'll be coming back and forth. So Bob, handing it off to you.
All right, great. Thanks very much, Andy, and thanks everyone for joining us here on Earth Day. I'm going to start by talking a little bit about why we worry about investing in fossil fuels. And so let's start with the first slide. Actually, I think it's the second slide, the next one. There, perfect. And I want to start by focusing on some lessons from financial risk management. Many of you may know that I spent a 33-year career on Wall Street. So I have an unusual background, at least in terms of fossil-free investing, in that I come from risk management background on Wall Street, and I'm an economist. I got involved in this space about 15 years ago, right before I left Goldman Sachs, where I had been head of risk management. And what attracted me or got me interested in climate risk was that it is a risk management problem. And I could see a lot of parallels to what I was doing on Wall Street. So let's go through some of the lessons from financial risk management and how they apply to climate risk. The first one is just that risk management requires that you consider worst case scenarios. Or as we often say now in the financial community, you have to think about extreme but plausible scenarios. And that's something that is rarely done in climate space, because historically, when scientists have talked about some of these potential outcomes that are, extreme but plausible, people say, "Oh, you're an alarmist." Well, if you're you're responsible for risk management, you have to think about those scenarios. That's what the job is. It's about thinking about what could happen, the full distribution of potential outcomes. And as I think most people are familiar with now, this is an experiment that we're doing for the first time. And there is tremendous uncertainty about what might happen. We don't know how bad it's going to be, but we have to be prepared for those worst cases. Now, the second lesson from financial risk management has to do with timing. One of my colleagues mentioned to me, and I thought it was a good insight, that when you're managing risk, time itself is a precious commodity. If you have enough time, you can solve almost any problem. But when you have a growing risk like climate change, and we can come back to what's going on right now, everyone's very familiar with the COVID-19 problem, and I think it's pretty obvious the cost of not addressing that risk management problem in time. Now, you might be wondering, why do I have this photo on the right side of this slide showing what looks like an explosion? It's actually a tanker full of gasoline that I nearly ran into. I was actually there when this occurred about 5 years ago. And I use it as an illustration of time compression, because I nearly got killed in that accident. My wife saw this truck coming at us from the other side of the highway, and she exclaimed, "Oh my God, Bob, watch out." Well, I slammed on the brakes, and we avoided running head on into that flaming truck by about a half a second. And had I not slammed on the brakes, I wouldn't be here today. So this is just one example of time compression. And I'm going to come back to why climate change is such an urgent problem. Third, though, this third lesson is that the purpose of risk management is not to minimize risk. Many people assume that that's what a risk manager is trying to do. In fact, when I was hired by Goldman Sachs to be the head of risk management, they had no intention of reducing their risk. The issue was, we didn't want to take risks that we weren't getting compensated for. And indeed, my whole career on Wall Street was one of trying to think about getting paid appropriately for the risks that we take. And that is the essential mistake that we're making with respect to climate change. We're not pricing the risk, and therefore we're taking much too much risk. And what we have to do, to an economist, it's very obvious, we have to price the risk appropriately. And I'm going to talk about what that means. But before I do that, let me just also mention the fourth lesson of risk management, which is that risk is what we measure, but uncertainty is what we manage. When we talk about risk, we're often talking about some metric. Maybe in the financial markets, it's volatility, value at risk. But with respect to climate change, it's risks of damages in the future that are very hard to measure. But in particular, no matter how we measure them, if you come up with a model, and I've done some work modeling those damages and the appropriate price of that risk, there's a lot of uncertainty. And what does that mean? Well, the implication of the uncertainty, as opposed to the risk measure, is that you have to err on the side of caution, which is to say, in the IPCC, the UN scientific body, several years ago pointed out that there's a lot of limitations with economic models of climate risk, and indeed there are. So we don't know what the right price is, but because it's uncertainty, whatever that right price is, we have to err on the side of caution, which is to say a higher price. Let's move on to the next slide. Now this slide, I apologize because it's a little bit complicated, but it's very important. It illustrates what is the cost of delay, or in other words, why is there urgency with respect to pricing climate risk. What you see here are two charts that have time on the horizontal axis, begins in 50, I think, and goes all the way to 2100. So the blue shaded area is the history, and then the white background is the future. In fact, as you can see, this slide was put together right before the end of 2019. And what you see in the top half of the slide is the excess CO2. You often see the amount of CO2 in the atmosphere. Right now, it's about 415 parts per million. But historically, there were 280. So the 280 is kind of the baseline, and the excess CO2 is the amount above that. It's not 400, it's about 130 right now. And that's what you see where the present is. And now you see a bunch of different lines there. And those lines represent the amount of excess CO2 that would be in the atmosphere at different points in time had we started globally pricing emissions appropriately, which is to say at a pretty significant level at different points in time. So if we had started in 1980, that's the first yellow curve. And you can see that by today would already have peaked and would be coming down. We would have already gone past net zero had we started pricing emissions in 1980. We wouldn't have had to have such a high price, And then what you see on the bottom graph is the cumulative warming that would have been caused by that degree of pricing of emissions. So if we had started pricing emissions in 1980, today we would basically be at the peak of warming. The peak of warming is around between 10 and 20 years after the peak of emissions. And then what happens if we delay that pricing? Well, if we delayed it 10 years to 1990, that would be the blue line. 2000 would be the green line in both graphs. Then the darker blue, 2010. And basically, if we were to start today, we didn't start in all of those different times. The global incentives have gone the wrong way as we've subsidized fossil fuels, both in terms of consumption and production. And here we are in 2020, and if we priced emissions globally immediately, you can see that it would take a long time until about 2050 to hit net zero, where emissions are basically peaking. And then it takes another 10 or 20 years, as you see in the bottom graph, to reach the maximum temperature. The key point here is look where that maximum temperature is it's gonna hit around 2070 or 2080. It'll be somewhere between 1.5 and 2 degrees C, pretty close to the middle right now. And the really significant part of this, and the really scary part of this, is look what happens if we wait another 10 years. Another 10 years, and we're on the black line, we're well above 2 degrees C. And many of you may be aware of the difference between 1.5 degrees C and 2 degrees C. It's extremely scary. At 1.5 degrees C, just as an example, the IPCC estimates that we'll lose between 70 and 90% of coral reefs. To me, that is a major catastrophe. But if we, and by the way, it's going to be very difficult to hit 1.5 degrees. If we price emissions above $100 a ton immediately, we probably won't hit 1.5 degrees. And yet, if we wait 10 more years, we're going to be well above 2. And at 2 degrees C, the amount of coral reefs that will be destroyed is over 99%. So rather than saving 20 to 30% of coral reefs, we will get rid of over 99%. Let's go on to the next slide. So what do we do about this? Well, we need globally harmonized and significant incentives to reduce emissions. The US right now is the major problem globally in terms of getting to those emissions. And we have a proposal, I say we because I sit on the board of the Climate Leadership Council, which is the sponsor of the Baker-Schultz Carbon Dividend Plan. That is the leading plan for carbon pricing in the US. Most people, I think, and including investors, are very pessimistic about the opportunity for getting federal carbon pricing legislation in the US. I'm actually quite optimistic. And one reason I'm optimistic is if you look at where we're getting support for this proposal, it's from virtually all of the corporate America, significant numbers of economists, 3,554 US economists. As you can see there, most of the Nobel laureates, the chiefs of the Council of Economic Advisors, the heads of the Federal Reserve. This is not a partisan issue among economists. There's no right and left. Everyone understands you have to price the risk. And then you look at the corporate support, not just from big corporations like Microsoft, Johnson & Johnson, Goldman Sachs. It also includes the major oil companies, ExxonMobil, Shell, Total, BP, and energy companies. We have tremendous support, including the environmental community. So WWF, where I sit on the board, World Resources Institute, Conservation International. We hope to introduce this into Congress on a bipartisan basis later this year. And of course, whether we get it passed is going to depend quite a bit on the election. But I think there's a very good chance we'll have a new administration with a new approach, and that we will get carbon pricing within the next 2 years. Let's go on to the next slide. What does that imply for investments in fossil fuels? Well, trust me, it's not going to be good. There's going to be very significant changes in valuations of securities. Investors are forward-looking, and the possibility, or let's say the probability, of global harmonized emissions pricing is being built into the valuations of fossil fuel companies. About 7 years ago, the World Wildlife Fund, where I sit on the investment committee, I chair the investment committee, and we discussed what should we be doing in our reserve fund. And one of the things that we talked about was divestment. But we decided that that was going to be a difficult thing to do. Our advisor told us, you know, you only have less than 1% invested in stranded assets, coal, tar sands, oil exploration and production. They said it's going to be very expensive to get rid of it. And we said, well, you know, we're the World Wildlife Fund. We want to make sure our reserves are aligned with our mission. And so what we came up with was what we thought was a cost-effective and innovative way to eliminate those stranded assets from our portfolio. And rather than you know, change our managers and sell private equity and all kinds of other things that would have been very expensive, what we did is what we called an overlay strategy, or a stranded asset swap. We basically sold those assets to a counterparty. And sometimes people say, well, who would take the other side of that? And I say the other side because we sold our stranded assets and we received in exchange the total return on the S&P 500. So I like this because, among other things, it was a very simple structure that was basically a bet that those stranded assets would underperform the market. I thought, you know, I think they probably will underperform. I had no idea, though, what would go on. And as you can see in this graph, which is the cumulative return from that swap, the underperformance has been, you know, more than 10%, 13% annually over the last 7 years. In fact, the cumulative performance inception to date is over 100%. And as you can see there at the end of that graph on the right side, particularly since the coronavirus, we've seen those fossil fuel assets very significantly underperform the market. But really, it started 7 years ago, and it has just continued, and I would say is accelerating now. In part, of course, recently due to the coronavirus, but over a long period of time, I think it reflects increasing expectations of emissions pricing. So I'll stop there and turn it back over to you, Andy.
Great. Well, thank you very much, Bob. We're now going to move to Kathy Hipple from IEFA, who will give us some more of the economic analysis. So Kathy, over to you.
Thank you, Bob. Thank you, Andy. It's a pleasure to be here. So I am a financial analyst at IEFA, and we are talking about the financial case for divestment. So IEFA, next slide, please. IEFA takes a global perspective. We cover the oil and gas industry, and we cover the energy transition, and we do it in the United States. Next slide, please. Asia, Australia, and also we have moved into South America, Canada, and so we really have a very broad view of the energy transition, which strengthens the case for fossil fuel divestment. Next slide, please. So there's a compelling case for fossil fuel divestment. Bottom line is the oil and gas companies have underperformed the market for a decade. This is not new. The energy sector, which is represented by fossil fuel energy, is shrinking overall. And today, these companies are in extremis. Funds without fossil fuels have outperformed. Next slide, please. So in case anybody was living under a rock, we know that last month, the reality of COVID-19 set in, and with it, the economic downturn that would inevitably follow. oil and gas demand forecasts plummeted, and then Russia and Saudi Arabia began the oil price war. In short, the world changed. Next slide, please. The industry view, or what they'd like to believe, or what they'd like us to believe, is that this was a black swan event. In fact, that is not the case. Next slide, please. The decline began long ago. Next slide, please. In fact, the energy sector, which remember does not include the way the S&P 500 does this, it does not include renewable energy. It is just fossil fuel energy. It has underperformed the market for a full decade. In fact, it was the worst performing sector over the past 10 years. It gave a return of 6% compared to the S&P 500, which increased by 190%. Next slide, please. And that was through the end of 2019. The decline has been even more dramatic throughout 2020, as you can see by this light blue line, which is far below all of the other sectors of the economy. Next slide, please. This is a really remarkable graph because it shows that the energy sector back in 1980, the end of 1980, comprised 29% of the S&P 500. Today, it is literally 10% of that. It's 2.6% of the S&P 500. So now we've got a situation where over the past several decades, the energy sector has become far less important to the world economy on a relative basis. Next slide, please. No surprise here, you can see that while the energy sector has been shrinking relatively, other parts of the economy have been growing tremendously, such as IT, healthcare, financials, etc. Next slide, please. Another way of looking at this, which I think is pretty extraordinary, is that back in 1980, 7 of the top 10 companies in the world were oil and gas companies. In 2018, only one company, ExxonMobil, still was in the top 10 companies. Next slide, please. It was huge news in September of last year that none of the top 10 were oil and gas companies. Exxon had fallen out of the top 10. Next slide, please. So we can look at the big oil companies that have fallen out of the top 10. In fact, only 3 are still in the top 100 companies in the world. It's fracking that has really, really performed terribly. And this, again, is not new. This is a decade-long situation. We follow about 34 fracking-focused companies, both oil frackers and natural gas frackers. And looking at these companies' cash flow gives a great insight into them. And they have been, in aggregate, their cash flows have been negative for a full decade, each year, every year for a decade. So again, this is not new. The events of March and April have accelerated a trend that has been in place for a long time. So for those studying finance, and even for the average person on the street, if there's been negative cash flows for a decade, what do you imagine has happened? Next slide, please. Bankruptcies have mounted. So this is a company in Texas that follows bankruptcies in the oil patch, and they have noted that there have been billions, 122 billion end of last year of debt that needed to be restructured. And last year, the number of bankruptcies doubled. Next slide, please. So last year, the number of bankruptcies among exploration and production companies, which are the fracking companies, doubled just last year. So it's no surprise, next slide please, that in this environment, indexes or funds without fossil fuels have outperformed. And if you can look at this part in the circle here, you can see that over the last 5 years, the outperformance has been substantial. We're looking at 3 to 4% outperformance for a fund. This is the S&P 500 ETF fund with and without fossil fuels, and you see a dramatic outperformance. And if you zoom out to the next slide, please, over the past 10 years, and you get, instead of just the S&P 500, you get the worldwide index, you get outperformance of nearly 1 full percentage point, which, remember, this is a hugely misunderstood, that this outperformance by funds without fossil fuels has been going on for a decade. It's not new, and we believe it will continue. So I think this is a perfect time to turn it over to Andy to talk about the work that is being done at As You Sow.
Well, thank you so much, Kathy. Really appreciate that perspective. So back in 2015, based on the work of Mark Campanelli, who you're going to hear from soon, this idea of a carbon bubble became, and stranded assets. As You Sow started filing resolutions with companies asking them the question about stranded assets. And so as people started to, the divestment movement took force, which is now $12 trillion of assets, have signed the divestment pledge. What they were signing was that they were going to be getting out of that carbon underground 200, the 100 largest oil companies, 100 largest coal companies based on their reserves. So people came and started asking, well, that doesn't include all of the fossil-fired utilities. That doesn't include pipelines and oil field services. So we built a site called Fossil Free Funds. And I'm now going to just take it, I'm going to go live with it and just do a little demonstration. It's our 5-year anniversary. As I said, we started this in 2015. And so I'm going to just take a look. So what you're looking at now is a live, this is fossilfreefunds.org. You can also access it through the As You Sow website. There's a thing called Invest Your Values, a button. So you can come here and you could type in Vanguard, for instance, and what you'll see is a listing of all the mutual funds. And so I'm just going to pick, this one is the Vanguard Total Stock Index, just to give you a sense of what we do. So we break down what's inside every mutual fund. We find there's about 100 million people with about $8.5 trillion in assets in 401k plans. That's all mutual funds. So for instance, we look first at the Carbon Underground 200. Again, those 200 largest companies by reserve. And you can see all of them that are in here. And you can also see what percentage it is. So this is 5.4% of this fund's assets, 129 holdings. But we go a little further. We say, well, what about the coal industry? So you can now see all of the coal industry that's involved. This oil and gas industry is every company with reserves, the whole oil and gas industry. So the Carbon Underground 200 is a subset of this. Again, you can look at all of them. You can also look at fossil-fired utilities. So all the companies that are actually burning coal, burning gas, and actually with very, very high emissions. We also have a button here for carbon footprint. And what this does is we add up the emissions, the scope 1 and scope 2 emissions of all of the companies within the mutual fund. We then divide by the dollar amount. So in this case, you have 213 tons of carbon per $1 million US. And that's a really important number. You can see where this particular fund sits against a bunch of all the different benchmarks, and it's obviously very, very high. So as people started to use this, and we started to get a lot of traffic, people saying, wow, I didn't realize if in my 401k I was invested in big oil, I was invested in coal. We started talking to some of our partners at Friends of the Earth. And so now you can see that we cover not only fossil fuels, but deforestation, gender, firearms, military weapons, etc. So looking over at deforestation, because that's obviously a very big climate issue. When this started, we were looking at just palm oil. And again, this is in a partnership with Friends of the Earth. So if you look here, we've now expanded it to cover both palm oil, paper pulp, rubber, timber, cattle, and soy. So these are all the companies in this fund that are literally cutting down and burning the Indonesian and the Amazon rainforest. You can see all the banks that are funding all of this activity. So again, each one of them is listed here, as well as all the consumer brands. So for instance, if there's a company that makes potato chips and uses palm oil, they're going to be in this list and may be held within your mutual fund. So there's 208 holdings, 12% of the assets are having to do with deforestation. And you can go ahead and look as you can see all of the companies here. And if you want to see a little detail on each of the companies, we have all of that, as well as we also track all of the financial performance of these different funds on a 1, 3, 5, and 10-year basis. Another way to use the tool is that you can go into looking at the top scoring funds here. You could say, I want to sort this by financials. So you could say, sort it, show me the top 5 by 5-year financial performance. And then you can go and you can say, only show me funds that get an A grade on deforestation, are sustainable, and are diversified. And the site's very quick. It just recalculated that out. And now you can click on one of those and you can see this is a fund that has 0 agribusiness banks, lenders, and you get a sense of what's inside. You can see how they also score better. They also don't have any military weapons, and how they do on the other issues. You can also use this to sort by major fund managers. So for instance, you could say, show me just all the dimensional funds. And we've just now aggregated up 55 funds. And you can see that dimensional isn't doing a great job on deforestation, but you can get a sense of all of their funds. So what's interesting is on the fossil-free funds, when we started this, there were just 10 funds that got an A, and now there are like literally hundreds of them. These are all funds that have 0 fossil fuels. People say, how do I invest in these? Basically, a lot of 401ks are ESG free. They do not have fossil free or ESG in very many 401k plans. We're actually working on that. We're going to be doing a report card for each company, ranking their 401k plan on these various issues. But you can see, as I'm just keep revealing another table, there are lots of fossil-free funds out there. And in general, as Kathy said, they tend to outperform the passive indexes because they don't have fossil fuels that are dragging them down. And so I just wanted to just say happy birthday to fossil-free funds and a call out to Andrew Montes at As You Sow, who is our Director of Digital Strategies, who's been in charge of building this entire platform. And that's why we decided to have this webinar today and to talk about this whole idea. And now I'm going to hand my screen back and turn it over to Mark Campanelli, who has always been a great friend and inspiration to us. So go ahead, Mark.
Thanks for that introduction, Andy. So let's go to the first slide. Yeah, the next one, please. So Carbon Tracker, we're a non-profit financial think tank. Most of us are either ex-Wall Street, City of London analysts. I spent prior to setting up Carbon Tracker 20 years in the investment management industry, or their data analysts, data scientists. And what we model is we model future coal, oil, and gas production. We look at the economics of coal-fired power stations and increasingly looking at gas. And we build financial viability tests for each coal-fired power station around the world. But we test all of that against the science of carbon budgets, which ask the question, how much carbon dioxide can we release to the atmosphere based on the cumulative CO2 in the reserves of coal, oil, and gas companies, whether state-owned or publicly traded. For purposes of today's call, I'm going to be looking at publicly traded companies, and I'm going to be looking at oil and gas in particular. I want us to imagine that you're running an oil and gas company today. You've got shareholders, you've got bank loans. What are you thinking about? What are you going to be doing next? And I'm going to be coming to some conclusions on that towards the end. So what are you looking at on this table? So what you're looking at is in the red bar and then the dark blue bar and the light blue bar is the proven reserves of coal, oil and gas that we know of around the world. And I want you to look at the two bars along the bottom. So the bar running along the bottom, which is a declining from 2011 to 2017, it's a declining bar. That's the remaining carbon budget to 1.5 degrees. And the one above that is 2 degrees. And there's a very simple takeaway from this graph is that there's, as we know, there's far more proven reserves of coal, oil and gas that we can possibly burn to stay below 2 degrees, let alone 1.5. And as a surprise to many people, that does include gas. There is an excess of proven reserves of gas as well. Gas is not a transition anywhere. And as the carbon budget declines, we have 40 gigatons of carbon dioxide emissions annually. That budget goes down. So we run out of runway for 1.5 degrees with a high probability of avoiding 1.5 degrees. We run out of that runway in about 7 years, 2 degrees within about 14 or 15, and 3 degrees in about 3 decades. And thinking and reflecting earlier on Bob's comments about the time lag between the emissions and the warming, is a very frightening picture. Can we move to the next slide, please? So what are the companies planning to do? And I am grateful to my colleagues at Oil Change International for this graph. What it shows is the steep declines that we need to avoid 1.5 degrees. So very steep pathways. We have to start, well, we know we need to start. It started 10 years ago. So what are the companies doing? And one of the messages to go away with today is that the oil and gas companies are actually planning for growth in demand. It was only a few years ago, we have to remember, that OPEC and others were forecasting a 50% increase in demand for oil and gas over the next couple of decades. And the models and the scenarios which the oil and gas majors are using all essentially come back to one thing, which is substantial increase in demand. And that reflects that will then impact on their strategy and their capital expenditure plans, and will also impact on their energy transition maps. What they will have to do, and what they're saying today, is they will de-intensify emissions by having a higher gas as a percentage of production, or they'll try and offset emissions through nature-based solutions or from CCS. Well, we may need those, but they certainly do not net off the future potential emissions from these companies. Next slide, please. So what do we do at Carbon Tracker? Well, we use data from Rystad, their energy database, and we build what we call cost curves. So we look at the highest cost producers on a project-by-project basis and low-cost producers, and I'll come on to that. And what we're trying to do is work out what percentage of the then, remember we published the Breaking the Habit report in November 2019, is most of the planned capex of the oil and gas majors are way outside the scenarios that we need to get to be below 2 degrees. And actually what we need to do, and that's on the right-hand column, is to begin to reduce production and certainly look at cancelling these particular projects. And with Carbon Tracker's work with Climate Action 100, engaging with companies really is around challenging their expansion plans. Next slide, please. So if you're not familiar with Carbon Tracker's research, you can find us on carbontracker.org. And if you follow us on @CarbonBubble, you can see the announcements of the research. We do like to get into project specifics. So once we understand the break-even prices of particular projects, we can then look across the portfolio of projects by the Shells and the Exxons and the BPs and identify which of their projects are high-cost projects. And if we can go on to the next slide, please. So So what I said earlier, what are the companies actually thinking? And this is from an IHS Market report from just a few weeks ago, and it looks at the unsanctioned new source conventional volumes over the next decade of hydrocarbons and their break-even prices. And if we look at where the price of oil is today, if you have in your core scenarios at Shell and Exxon growth, then you build into your models higher oil prices. And you see this also on the sell side analysts, that they build in models of $70, $80 a barrel in future years. If you think that growth is coming, that then allows you to identify projects that would meet sanction thresholds if you look at break-even prices. So what you're looking here is that as the different oil and gas companies, what percentage of their projects fit particular price bands. And if you can see that red arrow, what you can see there is quite a high percentage of these different companies require relatively high break-even prices. Now, the companies are arguing that this is all, of course, cyclical. These prices will come back. What we're arguing at Carbon Tracker, because of competition from new technologies, that we won't see prices coming back, certainly not to the higher end, because now prices are being beaten down as the internal combustion engine is no longer competitive against the electric vehicles. Next slide, please. So I mentioned earlier Carbon Tracker's cost curve. So what I want to do is tie back the concept of the carbon budget, how much we can release before breaking warming thresholds, to break-even prices. So what the red line is represents literally thousands of projects around the world, oil and gas projects. And what we're trying to do here is look at cumulative potential supply and carbon dioxide, and then work out, linked to the carbon dioxide, where the warming thresholds are. And so you can see that under those different scenarios, which we mentioned on the top, there's 1.6 degrees, 1.7 and 2.7. There's all those planned projects that the oil and gas companies are planning, and there are substantial assets that are in the potential pipeline that require not just very high break-even prices, but are based on the assumption that the world goes way beyond 2 degrees into the 3 degrees territory, which of course the Earth has not seen for millions of years. Next slide. Okay, I've used this slide before. People who've seen my presentations know it, but it tells a very simple story. And that is that the economics of the sector are tied to the ability to produce at low prices and sell at high prices. And again, this is the same graph that we've just shown you, our cost curve, but actually naming the projects and making the point that most projects require these high break-even prices to bring on stream. And it was just a short while ago that oil was at $60, $70 a barrel. Let's move that red bar from where it is there. Let's move it all the way to the left. And actually that chart starts at around $20. And what it essentially is saying is future production, a lot of that's going to be unprofitable. People often ask, well, pension funds require the dividends to be paid out. And I think Kathy's point about bankruptcies and so on is that if companies are producing oil at $50 a barrel and can only sell it at $20 a barrel, then obviously they're making negative returns, and they will have to borrow, which is what they've been doing to fund dividends, and that's no way to run a business. Next slide. So yeah, here are my concluding slides. I said, well, what is the market saying? And I'm grateful to my colleague Mark Lewis, who's on my advisory board, is now head of sustainability at BNP Paribas, for his article in the Financial Times just a few days ago. And he cleverly looked at what the US Energy Information Administration is saying about what's going to happen to oil, and also the International Energy Agency. There's a lot of text here, but what this basically says is that they're forecasting that demand, whilst it's dropping by 18 million barrels a day, will very sharply recover back to 100 million barrels a day by the end of 2020, and that actually global consumption will only fall by 5 million barrels. And one has to sort of, and the International Energy Agency essentially went on and said the same thing. So what we have to ask is, how credible are these scenarios. I think the world has, can we move on the slide? The world has actually changed because of COVID-19, and that people will find new ways of working. There's new price competition coming in from electrification. I think I've got my last slide is the next slide. And that the rosy picture being portrayed by the EIA in the US and the IEA out of Paris, and what we're actually seeing is some structural pressures with, and it mentions here that China and India are trying to outcompete Europe with very ambitious electric vehicle adoption rates. So I'm just going to stop there, and I think the point I'm making really here is that the industry asked to think about what's going on with the board. The board wants us to believe that this is cyclical, demand's coming back, there's no speedy energy transition, and I'm really making the point that there's a lot of unnecessary projects and a lot of unneeded capex, and then actually we're now into a new reality which really fundamentally changes the core business model of the entire sector. Thanks, back to you, Andy.
Great, thank you, Mark. And next slide, please. I'm going to invite all of our panelists back for, I guess, one more slide. So just, I see people have been, there's a lot of questions already in there. Let's see. So please add your questions into the Q&A, and I'm going to just jump right in here. So the first one is, you may have seen the news that the Saudi Public Investment Fund, controlled by MBS, bought lots of stock in European oil majors last week, including Total. This is a natural experiment concerning the effects of a serious decline in oil prices. When they get too cheap, someone will enter the market and scoop them up. Maybe it will be the Russians next. In any case, it's doubtful the new owners will be terribly interested in engaging around climate change. How do you feel, what do you think about divestment in this perspective? Kathy, you want to start?
I'd be happy to. I think that's always the interesting question, that owners of assets, of fossil fuel assets, often put themselves in the position of being the best stewards. And I think reasonable people can disagree on this, but I would really posit that if there's no financial case to own a fossil fuel company, it should be divested, number one. I think the second point is that you don't get a seat at the table if you divest. And my challenge would be that for all the investors in Exxon stock over the past 2 or 3 decades, I'd really question what the seat at the table has gotten them over these 2 to 3 decades. And my third point is that if you've got a strategy of shareholder advocacy or engagement, it's a more powerful strategy if you say, if you don't do as we'd like you to do as a large asset owner, then we will divest. But if you don't hold out the stick of divestment, engagement, in my opinion, is a hollow strategy. So I don't think just because you think you'd be a better steward than the next guy is a good rationale for holding on. There's no financial case to own fossil fuel stocks.
Okay, thank you.
Andy, can I comment on this?
Mm-hmm.
I'm kind of reminded by people buying shares in blockbuster videos. They were arguing, well, people are still going to want to watch films, just as their business model was broken by Netflix. At the end of the day, I think people bottom fishing is what they call it, buying stock at the bottom. What they're essentially saying is that there are no short or medium-term threats to the core business model of these companies. Now, there will be cyclical upturns and downturns and short-term phasing issues, but I think the near-term and real challenge to the companies, once you've gone back in and bought them, is how speedy can they recover given the face of competition. And as electric vehicles become cheaper to run and to buy than the internal combustion engine, what that's going to do is slap down the ability of oil and gas companies to charge a premium price at the pump, because people will just go, well, look, I'm just going to buy the cheaper alternative, and that's how the market's going to function. So I don't see any financial rationale to be buying in at this point, because essentially what you'd be doing is throwing good money after bad.
Okay. Bob, have we learned lessons from the response to the coronavirus pandemic that applies to climate change? You're muted, Bob. You're muted.
Yeah, there certainly are a number of lessons from the coronavirus problem. Number one is they're both risk management problems. They're both global risk management problems. And so one of the lessons is, you've got to deal with the risk management problem with a degree of urgency. If you don't, it can get out of control, and there's no going back. Another lesson is that it's a lesson about how globally interdependent we are. These are both problems that affect the entire globe, and it requires collective action. The third lesson is that we have to listen to science. You can't ignore the reality of what we learned from science. And so I'm just hopeful that when we emerge from this coronavirus, that smarter and more logical, rational policy will follow.
I just want to reiterate that. I think that for me, that's the takeaway from COVID, is that the leaders, when leaders basing their decisions on science, they seem to be having a lot fewer deaths and faster economic recoveries, and the ones who are basing it on hunches and trying to maintain the illusion that we're business as usual are suffering even greater. Let's see. I'm sorry if I'm looking really close to the screen. It's a tiny type. It's another one for Bob. What do you think about the Energy Innovation and Carbon Dividend Act, which has already been introduced?
Yeah, well, there's actually, I think, 8 or 9 different bills that have been introduced to Congress. And, I think a dividend plan makes a lot of sense, because what it basically says is this is not about the size of government. This is about relative prices and creating appropriate incentives to reduce emissions. And then it becomes actually a very progressive plan if what we do is take the revenues and distribute it back on a per capita basis. So I think it makes it a very practical approach, one that can be supported by both sides of the aisle. And there are details that we can get into, but to most people, what's really important is that we create appropriate incentives to reduce emissions. And frankly, there's no one who really disagrees with that. If you are disagreeing with the idea of appropriate incentives, I'm afraid you're beyond hope, because first of all, if you want to change behavior, you got to change incentives. And the word appropriate is it kind of has built into it that this is you can't argue against appropriate action. It's just now we can start talking about what's the right price. And I'm happy to get into that discussion, but because it's so uncertain, we do have to err on the side of caution. So, it's a longer conversation, but I think we're very poised to create globally harmonized incentives to reduce emissions. And sadly, if we don't create those incentives, we're just not going to solve the problem. Everything else that we do can help, and there certainly is a lot that we have to do, and we could go on and on about supporting innovation and new technologies and changing lifestyles and all of that. But if we don't create the right incentives, we're not going to get the scale that we need to solve this problem. Just a note on scale. This year, the estimates, even today, reflecting the length and size of this depression that is created by the coronavirus pandemic, that's going to reduce emissions. It's estimated somewhere between 5 and 6%. That's what we need every year going forward. So this is just the start. And we have to create those incentives in order to keep this going.
Okay, thank you. So Kathy, this is sort of a multi-tiered. I'm hearing an echo now from my voice. Can you talk about the dividends that fossil fuel companies have been paying, and will pension funds that divest miss those? And also talk about the European majors, DONG and Repsol, Total, and how they're going to be transitioning into energy companies that are really becoming renewable companies. I'm trying to paraphrase a long question.
Okay, well, I'll start with the dividends. And this question has come up because some of the fossil fuel, the big integrated oil companies, we call them the so-called oil majors, have historically paid high dividends. And the question is, I have 2 answers. These are not the only companies in the market that pay high dividends. And the second more important question is that these are unsustainably high dividends, in my view. They are financed by asset sales, and they have been financed by adding long-term debt. And if you look at the small fracking companies, the smaller fracking companies, they've gotten into tremendous trouble by becoming over-leveraged and taking on too much debt. So you see a situation where you've got the 5 big oil major companies, and for a decade, they've had to either rely on their cash reserves or their asset sales, which means they're selling something that they own, or long-term debt to fund about 40% of their dividends and share buybacks. So again, it's not sustainable. The second part of the question is looking at the oil majors, predominantly the companies in Europe. There is a move for some of those companies. I'm not going to talk about Repsol, I'll talk about the other sort of larger ones, to pivot toward renewables or green energy, or toward energy solutions that don't rely exclusively on fossil fuels. My view is that we would want to look at their capital expenditures and see what portion of their capital expenditures are going toward those initiatives. But as Mark pointed out, many of the growth forecasts for Shell and Total depend predominantly on growing their oil and gas, and I agree with him entirely. Gas is not a transition fuel, so they might lump that in with a new energy initiative. We don't view it that way at IEFA. So I would like to see what their capital expenditure budgets are before getting terribly excited.
Okay, you know, we're just about out of time. We have about, got to be 50 questions. We will write answers to these questions, and we will post them along with this video and along with the slide deck. I'm going to ask you each to wrap up. Maybe Mark, you could start just a minute, just to give a summary.
Yeah, I think it's less, some estimates done by my colleague Kingsmill at Carbon Tracker is something like less than 5% of global installed renewable energy has actually come from the fossil fuel industry. The other 95% has come from outside of the fossil fuel industry. So the idea that the fossil fuel industry can transform, I'd like to see it. We saw it with Dong Energy becoming Ørsted, but it had to completely revolutionize itself. Carbon Tracker, a number of years ago, we wrote a paper, which you can still download from our website, called the Energy Transition Blueprint. And we're thinking about updating it 5 years on, and actually start to say, what will a fossil fuel company in transition look like? What we would have to do? So one of the things that's missing from the discussion that I hear from the fossil fuel sector is what a transition plan would actually look like, a managed decline where they're actually exiting the sector, actually exiting the fossil fuel production. There may be uses for plastics and so on, and complex pharmaceuticals, but I'm not really seeing that language. What we're hearing is we can carry on what we're doing so long as we can do a bit of offsetting. And that's profoundly wrong. And those who are working on engagement really have to be asking for transition and exit plans from the sector, because we've got to get real change happening fast, certainly in the next couple of years, and there's no time to lose. I think that the next phase really of investor engagement has to be much more assertive and forceful, challenging the board, challenging and working with other investors, really to put in place orderly wind down plans.
Thank you. And Kathy, if you could wrap up, we only have a minute left, so sorry.
Absolutely. I would say the financial case for divesting from fossil fuel stocks has been strong for a decade and has only grown stronger as we've been able to see in the last couple of months.
Thank you. And Bob?
Yeah, I would just say, look, this is going to be a rapid transition. It's not going to be smooth, and I don't think that the speed of the transition is yet built into the valuations of these companies. And they're already down significantly. But as one of my partners at Goldman told me 7 years ago when we put on the stranded asset swap at WWF, he said, how can you be shorting coal companies? They're down 50% from where they were a few years ago. Well, that was down 50% on the way to zero. So that's kind of where I think we're at with respect to the oil and gas companies right now.
Great. Guys, have the last slide, please, which is just a disclaimer. So thank you, everyone, for joining us. Thank you, our esteemed panel. Have a fabulous Earth Day, everyone. Shelter in place, be safe, be well. Thank you for joining us. We will be posting all of this very, very soon, and we'll be answering all of the questions. There are many of them. So thank you all, and have a great day.